Travillian Next is hosted by the Travillian Group. Please visit www.travilliangroup.com to learn more about our specialty in the placement of board members, C-level executives, and other professionals within community banks and credit unions. Welcome, everyone, to another episode of Travillian Next, where we profile some of the more innovative minds within banking and fintech. I'm Brian Love, Head of Depository Recruiting at the Travillian Group, and I'm joined today with Stephen Hunter from CenterState Bank, Director of Strategic Risk Modeling. Welcome, Stephen.
Thank you.
So Stephen and I first got to know each other. I recruited him out of State Farm Financial out in Bloomington, Illinois. Recruited him down to CenterState Bank, who is a terrific client of Travillian's. We actually placed quite a few people in very pivotal financial roles. And of course, what was it, a year and a half in, just a fantastic merger of equals occurred, correct?
Yep. Yeah, from 17 to 34. And I think we're bumping up on 37 now.
Wow, a true player in the Southeast. That's going to be a lot of fun. And if we can turn the clock back a little bit to talk about your career trajectory, obviously we got to know each other when you were at State Farm, and I posed this kind of crazy role your way at this bank in a much warmer environment. I was just kind of curious. Tell me about what you were doing at State Farm, and why moving to CenterState was such a good idea for you.
Yeah, well, the sales pitch first from Illinois to Florida is a pretty easy one. Going all the way back, the first leg of my career was with FDIC. I had the chance to go through their corporate employee program where they take you to DC, you study for a couple of weeks, and then they put you out in the field and you run bank exams all across the nation. So I think that's where I developed my affinity for community banks and the niche that they play. Going from there, I felt like I was kind of ahead of the curve with FDIC in terms of banking acumen, but I really had no experience whatsoever in terms of executing a strategy and putting together processes and seeing how that works. So it was an easy transition going from the FDIC to State Farm and trying to kind of learn how to navigate a Fortune 50 culture, learn what that corporate structure feels like, how to influence, then along the way, just picking up as many hard skills as possible. It's a very quantitative institution, lots of actuaries. They give you the opportunity to really look at your predictive analytics, building an acumen in R, Python, SAS, Tableau, all of those different software solutions for the enterprise. You reached out exactly when I was about to finish up my executive master's program at NYU. Mm-hmm. I felt like change was on the horizon. I felt like between the acumen I developed at the FDIC and my ability to operate at State Farm, it was probably time where I could go out and I could really do some good if I hit the ground running and had the latitude to put together my own program and kind of find my voice and learn to operate. So the opportunity at CenterState was perfect timing. There's a bit of a nostalgic feeling in terms of getting back into a community bank, walking into a branch versus a financial services conglomerate. And it just felt good to have those close relationships with the leaders and with the analysts and being able to do what you think is right for that program.
Sure. And, you wind up down there. I guess it was the summertime too, wasn't it? When you went down there, it wasn't too hot, hopefully. But you dove right in, and I'm kind of curious, take me through the ensuing couple of years and what you're doing now.
Yeah. So, CenterState went from a $3.7 billion bank to a $37 billion bank in 5 years. Mm-hmm. So I caught that wave just after they crossed the 10 billion threshold, which was significant under DFAST times. That's since been rolled back, but there's still that regulatory expectation and even an internal commitment to putting together a sound risk management program that includes capital stress testing. So they brought me in just past that $10 billion threshold and said, hey, put together what you think our bank should have. The OCC released those capital stress tests principles where they say, hey, you don't necessarily have to run our scenarios. You don't necessarily have to do it the way that DFAST banks did if you're a bank between 10 and 50 billion. And they let you be more creative in what you put together. So I had fun putting together a capital stress test program. I used a lot of existing resources. We used our Empyrean interest rate risk model, repurposed the CECL models, brought in new production models for loans and deposits, and a lot of the budgeting software fueled our non-interest income and expense line items.
Oh, terrific. A little shout out to John Finley, right? Who I worked with very closely on several searches. What I liked about CenterState, and then we'll segue to what you're doing right at this moment now for the South State entity, was that, they were looking for kind of a unicorn in some regards, someone who was emerging and maybe a little earlier in their career, but also someone they could, empower to exert a lot of influence, on this initiative. And they really do a great job empowering employees at this company. And that's what I really love about them.
Yeah, and I think that's something that's become more valuable in today's climate where we're a little more isolated, we're working from home, we're still trying to collaborate, but from our respective geographies. I think that being able to see a project from start to finish, not just being a cog in the wheel where you're handing off between departments, I think there's a lot of value in just being able to see what your output is more directly. Something that I've grown to appreciate here at CenterState or South State now.
Yeah, I'm sure you got to get all the new pens and all the new stationery. But so you really haven't been doing too much. I think you've just developed 50 models on your own. There's 97 charters South State has that you've been aggregating data for. Just a little bit of work, it sounds. And also Empyrean, which you had no idea how to use previously. You're now, dare I say, a rock star with that software. So just take me through some of the challenges of, now it's an MOE, you're almost 40 billion. Again, from 3 to 40 billion in 5 years is just amazing growth.
Yeah.
Where does that sit you now at the organization?
Yeah, well, so we stood up the capital stress testing and capital planning infrastructure for the CenterState level. As soon as that's finished, rip off the Band-Aid and here comes South State, and then we're going to double in size. And that means that you're redeveloping all of the models that you just built. You're trying to figure out what your segmentation should be on a combined basis for each portfolio. You're deciding which legacy models should survive, where you need to redevelop new models, and just making all of those decisions on a combined basis now. So in a way, it's back to the same spot we were a year ago, but we're starting from a much better position, having that previous framework to rely on.
Sure, yeah, that foundation that you helped create. So, this is an interesting, kind of learning moment for the banks that are, that may watch this video. I've talked to banks that are well under 10 billion. Someone from one of those banks came to you, Stephen, and said, you got zero budget, but we need to create a capital stress test. What was your guidance be from there?
Yeah, it's back in the DFAST days, it was common to see $1 million, $2 million, $3 million, $5 million be spent to stand up your capital stress test that first year. And it was just, you had to do it because that was the regulation.
Vendors and whatnot, right?
Yeah, absolutely. Bring in as many as you can because you have to get it done and you have to put together that report by June of next year. And it was a very intense, you had to spend a lot of money to get it done quick. Fast forward to today, you have the principles for capital stress testing that you can follow, and you can put together a good capital stress test that will inform management decisions and let management sleep better a little bit at night, knowing that they can survive XYZ type of scenario. If you think about it from a how can you minimize your incremental spend and still put together a valuable capital stress test? You've got resources via the FRED, you've got federal unemployment, you've got federal websites that can produce all of that macroeconomic data. You've got FDIC call reports. FDIC has tools on their websites where you can pull your historical data, your competitors' historical data. You can combine and aggregate historical call reports if there was M&A activity. You can go out and R Studio, Anaconda, Pandas, Python. These are free services, free software, open source software that a lot of colleges are just teaching as part of their predictive analytics curriculum for the quantitative type of majors. From a non-interest perspective, you probably have historical files, budgets where you were looking at budget to actual. You can combine those, come up with some sort of sensitivity analysis to that macroeconomic data via Excel. I mean, today, you don't have to spend $1 million, $5 million to put together something that will give you value. You can just use public data sources and a little bit of business acumen and some hard skills in terms of R, Python, or however you want to aggregate that information. You can put together a capital stress test.
This is a moment where people, talent within banking is shrinking, and data is, cross industry. So what's your take on, how to maybe surround yourself with people who can execute this?
Yeah, you've gone from the age-old adage of hire for aptitude, train for skill, and it's almost flipped backwards to where you're trying to hire for hard skills, and then whoever can bring in these hard skills and do a good job of building bridges between the people, the analysts with those hard skills, and the leaders or the more tenured associates who have that business acumen, building those bridges, whether it's through formal mentorship programs or even reverse mentorship, where you're kind of equipping the leaders with some of that boots on the ground knowledge of how these models are coming together, so that the executives can better understand how strategy can be informed by these new skills that are in your bank. I think that's the way to do it. You've got to get people in who have those hard skills and are able to put together either automate a process using these SAS or Python type of languages, or can see the potential for building models once they're connected with that business acumen from the more tenured associates. I mean, that's the path to the future. Both sides you need the people with the hard skills, and you need the people with the business acumen. One by itself is not going to be leading banks 10, 15, 20 years from now, because you have so much pressure from fintech.
Well, and you mentioned Patrick Sells and how you watched, our inaugural episode with Patrick. That's the very definition of being innovative. It doesn't mean having the flashiest software and hardware and computers and whatnot. It's thinking differently. And that's what I get from you. I guess the question about culture, how has CenterState and now South State, kind of embraced that type of culture from your perspective?
Yeah, I don't know if it was Patrick that said it or if I heard it somewhere else, but someone referred to having the mobile app developed and deployed and having a best-in-class website as just table stakes nowadays. And I agree, because it's really all about, once you have those, what are you going to do with all of the data? There's tons of data that's created as a result of having those kind of windows into your customers' behaviors. How are you going to connect different departments across your bank with that as a data source that they can use to inform their respective processes? I mean, what could you garner from when you were offering forbearance programs back earlier in 2020? Could you have learned anything from looking at how many times a certain borrower, a certain depositor was looking at their account leading up to when you were offering that forbearance? There's just tons of different uses for that data. I think you got to find systems that allow as many associates as possible within your bank to make decisions off of those new data sources.
So I guess a final question, to get someone who's got such a wealth of knowledge in this moment that we're in here in 2020, heading into 2021, what is your outlook on what to expect for your organization and for the industry?
Yeah, I kind of think that 2020's brought three things to the table that I'm focusing on now that I probably wouldn't have focused on as closely a year ago, ex-pandemic. I think that being more agile, I have to be able to run scenarios more frequently than I thought I would have a year ago. I've got to be nimble in terms of putting together a forecast using a scenario from Moody's versus a scenario from the Fed versus a scenario from my chief strategy officer. I've got to be able to run all of those, and I've got to be able to do it quick, and I've got to have confidence that my controls are in place and that I'm giving good results to my executive team. I think that data is on the table. We've been saying for 20, 30 years for all of time, definitely my entire career, that you have to make sure you're collecting the right data. But I think an idiosyncratic event like what we saw this year brings that back to the table. And you have to really think through, like, for example, with the forbearances, how many banks were actually making decisions regarding what borrowers should have forbearances, how long those forbearances should be, 30, 60, 90 days, 120 days. Who was making those decisions with data? Probably very few banks. But now that we've lived through this 2020 pandemic, we've seen what borrowers have done. Are we collecting that data so that next time around, when we go to offer a forbearance, are we collecting all of the data that we need? Do we know who took forbearance, who didn't take forbearance, who should have had just principal and interest versus interest only? What were the ultimate results? Who defaulted, who didn't default? And on average, what should we be doing during the next pandemic or the next whatever that event is? And there's just tons of data that was generated as a result of this pandemic in 2020 that should be used to inform future decisions. Then I think finally, stylized scenarios. I think that the old way of just producing a baseline, a severely adverse, maybe a couple Moody's scenarios, that's not how we're going to stress test in the future. I think that stress tests in the future are going to be much more stylized. There's going to be a narrative behind it. We're going to get more in depth in terms of what we're analyzing. It's not just going to be use national macroeconomic forecasts to determine what's going on with your loan book and what kind of losses would be resulting from that. It's going to be what happens if, we have the blueprint from 2020. What happens if there's a bad flu outbreak that impacts your aging demographic more than your young professionals? What does that look like as it goes through your books? What happens if there's a downturn in hotels? How does that impact restaurants? We know that now. We can look at the data and understand all of those cross correlations. So I think the future of capital stress testing is much more tailored scenarios with this stylized narrative supporting it. And you're going to include a lot of people in that. You've got to understand how it impacts all of your different processes. It's not just Stephen looking at this from a modeling perspective and putting together a balance sheet. It's trying to understand how a decline in the hotels would impact the operations area. How would it impact business continuity? How's it going to impact credit? How's it going to impact our depositors? And how are all those behaviors going to change in all those different areas? So it's just much more tailored scenarios as a result of what we went through this year.
So on that note, Stephen, just wanted to thank you once again for your time. Very informative. You definitely have a bright career ahead of you. I'm happy that I was able to get you down to Florida, kicking and screaming. I've really seen you flourish there at CenterState and now South State. And I wish you the best. Thanks so much for your time.
Yeah, thank you. I appreciate everything you've done for me, my career, my golf game, and thank you for the opportunity today.
All right, send my best to all of your compadres there at South State. Look forward to working with you guys again in the future.
Will do. Thanks.